In the meantime, we've got a big Wall Street whale with us right now. Is he retreating from risk or in it to win it? Let's get right to the floor show. Joseph Tanious is right here with us. He's chief investment strategist at Northern Trust, which manages more than $1 trillion in assets. I said you were a big whale, Joseph. What are you doing? Are you risky? You risk avert right now?
I think we're embracing the resilient economy. We're acknowledging what's happening with corporate profitability. And I think while we have to acknowledge there are clearly some risks and there are a lot of headlines and there's a lot of noise out there, we are risk on. I think we continue to believe the equity markets are going to have a good year driven by the underlying fundamentals.
Well, you look at the NASDAQ here and don't make too much of a single day. I just am surprised that you would see the NASDAQ down on a day where Micron absolutely rocked it. And Micron supplies all the hyperscalers with these memory chips that are so crucial when it comes to the data centers. And yet you don't have the hyperscalers who need to buy these moving higher.
I think going back to one of the themes that we were looking into 2026 before this year even began, you're probably not going to see this rising tide lifting all boats anymore. You have to start to discern between the haves and the have-nots. And what we're seeing play out right now is a perfect example of this fracture within the AI narrative. It's a K-shaped everything, even within this AI story. There is this promise of productivity to come from artificial intelligence. But in the near term, I think we have to acknowledge there is the very real risk that all of this pricing pressure creates some near-term inflationary pressure. And I think what you're talking about now with chip makers, the impact that's having on Apple, for example, and then passing those price increases along to consumer, there's a bit of a disconnect there.
And then you throw in oil, which, by the way, has come steeply off the highs of the war, which began February 27th. So that at the high was $119 a barrel for West Texas Intermediate. Right now, we do have it at $72.26, but it was below 70 this morning. And then the Wall Street Journal had a report that Iran is definitely stuck on charging for ships transiting through the Strait of Hormuz and that they're planning on making billions of dollars by doing that. And suddenly oil reversed and went higher. So that piece of inflation is still affecting consumers, considering before the war it was $67 a barrel, and we got inflation numbers today, the PCE, and they matched, but there were some pretty worrisome questions there. I mean, you started to see that year over year, up 4.1% for the headline, and that's not good. Again, that's really, really high compared to what the Fed would like it to be at, which is 2%. Year over year core was certainly a match, I believe it was. No, actually, let's see, core, 1.6%. That's capital expenditures for durables. So, you know, the PCE, I just think at 3.4% was a match, still too high.
Match, but certainly, I think, better than fear. That's one thing. And the second thing we have to acknowledge here is that it is a little bit old news in the sense, as you just pointed out, we've seen oil prices come back down. We've flirted going below $70 a barrel. Who knows what's going to happen over the coming weeks? But by and large, I think we need to acknowledge the agreement that we have today, while it is welcome, it is fragile. Just as you pointed out, we had some headlines earlier this morning, a little bit of noise, a little bit of volatility. That's something we have to acknowledge. But so long as both sides of this agreement have an intention and have a desire to have some resolution, and that does appear to be the case, I think we can hope and we can assume that we've seen peak oil prices, and then from here, you should start to see some disinflationary pressure as a result of these oil prices coming down. I mean, over the past couple of years, it was what? It was higher oil prices or it was tariffs. Both of these shocks, I believe, are now behind us, and things should start getting a little bit better.
How about the Russell, though? Quarter to date, forget year to date, quarter to date up 19%. So just to go into an index that's small and mid caps, or you go into the Russell 1000, how do you view that as an investment?
I think we continue to believe the equity markets have some upside. And whether we're talking about small cap or large cap, I think there's some benefits, pros and cons, certainly to both sides of those. But look, the equity markets overall this year, putting in these returns that we've seen, this has all happened while valuations have actually compressed. Right? Multiples have come down. Markets have become less expensive since the beginning of this year. And I take some comfort in that because it means that the underlying earnings are really what's driving these returns.
Well, yeah, there's some real money coming into these companies.
Yeah.
So there's that. Different from the dot-com era for sure.
Absolutely.
Joseph, great to see you.
Likewise.
Thank you very much.